Welcome. We talk a lot about the companies that do have it. Who doesn't?
Well, I think that, the companies that are going to do well here, Kelly, which is, I think is important, is that, your defense companies obviously are going to do well. I mean, and from two perspectives. Number one is that there's going to be a demand for defense items, both domestically here on a short term and on a long term basis. And we're going to see also, significant sales that are going to go to our allies. So so we're going to see those companies continue to do well. Our favorite there is certainly Lockheed Martin. It's something we bought over about 6 months ago, actually, based on fears of Russia and mainly China. But I think those are going to do well. Some of the industrials, frankly, are going to do well on the rebuild, not only from the war itself, but we're going to have companies that everybody's worried about their supply chain. They're going to build more domestic factories. They're going to do well. Energy complex is going to do well. I think Chevron will be our favorite right now. Still, it's had a dramatic run. It's up from 133 to 170, but still yielding about 4.3% right now at about a 17 PE. Dow Chemical fits in the same category for materials with about a 4.5% yield. And look, tobacco, people are going to drink and smoke no matter what's going on. And if they're upset, they're going to do more. So one like Altria with a 7% yield while you wait and still sitting at a 10 PE.
I see Tyson in there, which has so much pricing power. I think the administration's gone after them. But across consumer staples, are there names that jump out to you? That's traditionally where people are always focused on pricing power. What about big cap tech, which seems to be, the new staples?
Well, look, it's going to be a player. I think the big cap tech still concerns me a little bit with regards to valuations. It's very interesting in this market. We have a lot of things that are taking place that certainly could loom a recession, even though that's not our opinion at the moment. You've got literally a war with a nuclear power going on. And the only thing that's really happened in the market is, frankly, we've contracted 12%. We've really come down to where we should have been anyway, in an environment where you're going to have inflation, slowing earnings, and increases in interest rates. So the overall market's at about 19.3. Value is about 15.2. Market's in line with 5-year averages. Value is almost right on long-term averages. The growth side, dominated by the big tech companies, is still a little high. Average is 21.5. It's still at 21.6. So they're going to be players. They're part of the big indexes. People are definitely going to gravitate to it. But I think I'd probably, if I'm looking for value in a slower growing economic and earnings market, I don't want to be overweighted there.
Okay, Dan, but if we're using your filter of pricing power to understand who's strong or not in this position, and we apply that to tech, it's interesting. We just saw Apple release an iPhone or announce an iPhone SE this week that's more expensive than previous models and some expensive computers. We've seen Netflix hike subscription prices, but then you see the cloud players continue to bring a lot of prices down at the same time, trying to grab shares. So how should investors think about pricing? Sometimes it goes higher to show strength. Sometimes it goes lower, it seems, to show strength as well.
Right. Well, I think, John, you're bringing out some good companies and some good plays there with regards to people, in my opinion, should have some core positions in these companies because they're going to be players. And as I mentioned earlier, they're going to be part of all the large indexes. So people are going to, in all likelihood, if you look at the averages now, they're going to maintain at least a minimum 10 to 15 or 20% position in tech, and they're going to get a play. So when you look at the pricing side, look, it's going to be based upon where the consumer is and where the consumer is going to drive those. My a little bit concern about some of these discretionary items is what's happening to gasoline prices. I mean, gasoline prices for the average working family or the average working person that has a 20-gallon tank and they fill up twice a week. I mean, this is going to cost them, if prices stay here up about $1, it's going to cost them an extra $2,000 a year. And if you look at the average person making about $57,000 a year, their disposable income just went down 3.5%. So they're going to have to adjust somewhere.